I've gotten a lot of requests to kind of talk about options, because options is definitely something that I use and I've been using more. I've been getting more sophisticated as, I've been doing this for 22 plus years. I used to just buy calls, and now I've learned how to use call spreads. I used to just buy puts, and I've learned how to use put spreads. I have been shorting some naked options here and there at extremes in the past year or two. So it's been a big part of my P&L. I think in 2020, options were probably 25% of my income of what I made on my P&L, where it was never that big. And last year, I think I broke even on my options just because I got caught short calls with AMC twice. But anyway, so basically just to break it all down, who knows what calls are? Say it. If you want to go up, what do you buy?
Calls.
Okay. If you want things to go down, what do you buy?
Puts.
Okay. So that's just the basics. Calls you're buying to go up, puts you're buying to go down. Okay. You have two components of the cost of your options. It's time, okay, and then depending on what strike price you use. Okay. So if I were to buy options for March and options for May, which would you think would cost more money? May, because you're paying for more time for your idea to work out. Okay. If I was playing a stock at 40, and I went out to April and bought the $50 calls, and I also wanted to buy the $60 calls, which do you think would be more money, the 50 or the 60? 50. The 50 or the 60? Why?
Because it's closer.
It's closer.
Yeah.
It's easier, more likely to do than it going to 60. So you need a huge move for it to go to 60. So it costs less to buy those options because there's less probability of it happen. So the further you go to where it's trading, they say it's further in the money, or out of the money. So closer is in the money, further is out of the money. So basically, those are really just the dynamics of options. Sometimes, people trade options in highly priced stocks because it helps, be cost effective. Like you could trade options in Amazon. If you want to buy 1,000 at Amazon, what's that going to cost you? If it's at 3,000?
Oh yeah, right now. Yeah.
It's going to cost you. Yeah. Okay. If you wanted to buy 10 calls of it to go up a few $100s, the premium could be like $30. So you might be spending $30,000 to control 1,000 shares of the stock instead of 3 million. So it's so people use options as a way because some of these prices of the stocks. Yeah, and plus your risk.
So what was the math?
So if you you could have like one contract, 10 contracts. So you could have any number, but it correlates to the amount of shares. So 10 calls is equivalent to 1,000 shares.
And that's one contract, or that's 10
No,
contracts?
10 contracts.
Every contract is 100 shares.
Yes.
Oh, great.
Okay. So so that correlates to every contract is 100 shares. So I guess I'll go to the board real quickly before we do this. Right. So if you're 55, okay, and you bought the $50 calls, okay, that's the intrinsic value, the difference between the strike price and where it's trading, okay. But then you have to put in the time value, okay. So if just say it's trading at 55 and you bought in the money calls, so you're automatically it's already $5, okay. If just say you were going out a month, maybe the options would be worth go out a month $8. So if it's trading at 55, okay, and the option cost $8, what's the time value cost? 3. The difference between the intrinsic value and paying $3 to hold it for however long your time frame is. So I could do this 1,000 different ways. I'm just trying to keep it simple. So the cost of the option is the intrinsic value and the time value, and typically as you get closer to expiration date, which is what you buy, the time value diminishes because it's not worth as much because the options are getting closer to expiration. So it always comes back more to the intrinsic value. So just say, it's today and next Friday, you're saying, you know what, I don't want to buy this stock, I don't want to sit in the stock, I want to just risk up versus 50, it's at 55, so I want to just pay $8 to sit in XYZ stock. If all of a sudden, today is, Thursday, and next Wednesday, if it stayed at 55 and it's expiring on Friday, how much do you think this option would be worth? Well, on Wednesday, 6.
Yes, 6.
So you lose a little bit of time value if you're not right closer to your expiration, okay? So then all of a sudden, if on Friday it closes at 55, where do you think the option closes?
$5.
$5 because there's no more time value left.
Maybe even
Right. So if, just say a stock's trading at 45, okay, and you want to buy the $50 calls for next Friday, is there any intrinsic value? No. So you're just paying for the time value, which we're going to do an example up there. So, someone would say, hey, you know what? I think this is going to go to 55 by next Friday. It's trading at 45. I want to buy. I don't have 45. I want to buy 1,000 shares, but maybe you don't have $45,000. So they say I'm going to just buy 10 calls, which is equivalent to 1,000 shares. And all of a sudden, on this day, it costs $2. That would make sense, right? You're paying $2, okay, to have the right to own this stock at 50, okay, because you think it's going to 55. Does that make sense? So if all of a sudden you bought it at 2, and next Friday, okay, it closes at 55, what, on the nose that Friday, what's the option worth?
$5.
$5, because that's the intrinsic value. What did you pay for it? $2. So what percentage did you just make? 150%. You made 150% on the $2 calls. If you had 1,000 shares of the stock and it went from 45 to 55, what percentage is that about?
20 plus.
Is that 20%? So if you owned 1,000 shares of stock, you made 20% on your shares. If you just put $2,000 on the line and it went there, you made 150% on your money. What's bigger? 150, because it's leveraged. Options give you leverage. But if you're in the stock at 45, okay, you have 1,000 shares, and you also buy it at 2. Next Friday, stock's at 48. Okay, how much is that option worth? Zero, because it never got above 50. So you paid $2 for a week to hold it, went there, but if you were 1,000 shares of the stock, how much you up? You're up $3,000. So you make $3,000 here because you're up 3 points, and here you're losing $2,000. So, but if it went to 55, here you're making, 10 grand, and then, well, you can't do it like that because then if you put 45, 50, that'd be like, 90 calls or whatever it is. So, so here, you're on your equity, you could lose it all, or you could make a bigger percentage. So that's when you trade options, it's about running out of time. It's about you want leverage, and you also could define your risk, because again, if just say you bought these options for $2, and bad news comes out, and this stock goes to 30, and you have 1,000 shares overnight, how much do you lose? $15,000. How much do you lose on the options? $2,000, because risk is premium paid. If you buy options, if you buy calls or buy puts, the only thing you could risk is premium paid. So that's why we take options into earnings, because like, hey, I'm going to risk $5,000, to be right on earnings versus, holding X amount of shares into earnings. That could be a binary event and lose you or make you a lot of money. So into binary events, I tend to use options because at least I know my risk versus unlimited risk. I'm not.
And when people say like rolling it over, what are you doing? Are people then selling the call options they bought?
Rolling it over sometimes is like you're going, it didn't work and you're doing it again 2 weeks later. You're rolling your options 2 weeks later to give you more time.
Or, like if you go from 50 to 55 and you think there's still a lot of juice behind it, you can cash your money out and buy up to the 60 so you have less premium now, risk.
Exactly, less on the table.
Take some, like your initial out.
Okay, and then just roll it out another.
Right. So yeah. So just say all of a sudden Mike was playing the options and he bought the 2, and then all of a sudden, it gets to 57, by next Monday, in 3 days. And you're like, holy cow, it's at 57. Okay, I paid 2. The intrinsic value is now 7, and it's only Tuesday, and there's still $3, 3 days left. Maybe there's time value of $2. So now you have so now you have a $9. So now your calls are worth 9. You're like, holy shit, I just tripled my money, So I don't want all of a sudden this thing to fall back down to 52, and I lose all that. So I'll say, hey, you know what I'm going to do? I'm going to sell, the 50s, okay? Take my $9. And then maybe just go out and buy the 65s for $1.50. So I'll risk $1.50, book that just in case it wants to continue. So you're rolling it into, another option strategy, because this one you want to protect a bit.
Another strategy in that scenario is that you just turn it into a call spread.
Yes.
And sell the upper strike against it, which then you collect money on, right?
To help finance it. Yeah, you say, oh wow, you know what? I paid $2 for the 50s, and now it's at 9 at 57. I could then sell the 62 50s for $2, and all of a sudden my initial $2 is off the table because that's what I put into it. And then if it goes to 62, and it's Friday, what's the intrinsic value? 12. So you kept it in 9, it still went to 12, and you took in $2. So really, it's like 14. So if you buy options correctly, you could turn them into spreads. The best thing ever is when you buy, stocks like this, making a nice little wedge, and you think it's going to break out. You're like, okay, I'm going to buy, the $20 calls for, $1. It's trading at 15, and then all of a sudden you get that breakout move. And goes to 22, and it's now at 250. You're like, wow, you know what? Now I could sell the 25s for the same dollar, and I just financed my call spread by being, timing it correctly. That happens every now and then, because we're good market timers. When patterns ignite and go, if we do options correctly, and then you get a 3-day move, like we like to time these 3-day moves, you sell half, and then I usually take the other half and I create a call spread, because if it continues to go, you want to make more, but if it doesn't and it just hangs there, you get to keep the premium that you sold above.